today's Lunchtime Stock Club webinar, we're going to take a look at the market year to date and what's driving it, talk about the current market conditions a little bit. We'll also cover a small company stock of interest to you. So first of all, where do we stand in the market? As it turns out, if you haven't been paying attention, here is the market year to date of the S&P 500, which is in blue, the Russell 2000, which is in green, and the Morgan Stanley EFA, the Europe, Australasia, Far East International Large Cap Index in red. And they're all up solidly year to date. With an 18.6% gain for the S&P 500, 15.8% for the Russell 2000, and 12% for the international stocks, which have come back a little bit from some down periods. So those are all pretty respectable gains as we are halfway through the calendar year. And there's been a lot of good news in the economy that's been helping those along. If we look at the S&P 500 PE ratio, you can see on the far right, it's at just above 22 at 22.13 using estimated trailing 12-month earnings. And you can see where that is relative to the market history. So we remain a little bit elevated, but as you can see, the PE ratio has come down a little bit in the last few months. It's reached almost as low as 20, and now it's ticking back up to 22. Much healthier place than we were for much of 2018, in my view. While the market is up, the important thing is that earnings are up. Here's the earnings for the S&P 500, and they are at an all-time high, again, on a trailing 12-month estimated basis at $135.39. And of course, we need those earnings to continue to go up in order to drive share prices up. And so this is good news. This is what we do as fundamental investors. We try to capitalize on the long-term trend of companies that are growing their earnings, and then we'll see their share prices grow accordingly. And so when we see strength in the large cap market, as we see here, we see companies continuing to perform well. That's a good sign. Of course, it doesn't mean that we'll always be that way or that we'll continue for the rest of the year, but it is good news for the stock market in that it's providing some basis for the valuation of the market as it stands now. Lots of people have been saying for years now that the market is too expensive, that stocks are priced too high, that we need some adjustments there. We have had quite a bit of corrections in the market, and that has helped along the way to smooth things out when the excesses reach such a high level. And I wouldn't rule out the chance of another 10% or more correction later this year. The market tends to push upward and then retreat a little bit. We've had a little more volatility this year. I think in the big picture, that's a good thing. And so I'm not at all concerned at this point about where the market is going and where we're headed from here for the rest of the year. Keeping in mind that the markets are subject to all sorts of rational and irrational forces, so we can't rule out anything. But all in all, as we enter the summer and enter perhaps a little bit slower period of the market, as a lot of Wall Street starts to take vacations and 4-day weekends out to the Hamptons, and business kind of slows down in a lot of segments of the economy. So I think we're in good shape. As always, our admonition to focus on quality at reasonable prices is our recipe for long-term success, and that remains true. In the July issue of our Small Cap Informer, which we published last week, I discussed the small cap indexes, and those of you who've been following our lunchtime webinars know that I've been tracking the small cap segment of the market, the large cap segment of the market, and the large cap international markets as a way of gauging performance of equities around the world, not only in the United States. And for the small cap segment, the traditional small cap index is the Russell 2000. And as I've been doing some further study and thinking about that index, I've come to the conclusion that perhaps it's not really the best way to measure small company performance as it relates to our approach to small stock investing. Our newsletter is the Small Cap Informer. Those of you who are members of Better Investing and are aware that we don't really measure company size by market cap, but by the size of revenues, the amount of revenues that a company can generate. And so the rest of the market tends to group companies by capitalization. So you've got companies that have relatively low levels of sales, but they have a high-flying stock price, and thus they are considered large cap stocks. And so from our perspective, those companies are not really large, even though they exert an influence in the market because of the interest that they generate amongst stock investors that's outsized relative to their actual size. And so the conclusion that I came to is that perhaps the small cap 600, which is an S&P index, is a better way of measuring performance of the small cap market. It's a better benchmark perhaps than the Russell 2000. So this is a graph of the last 5 years. The blue line is the Russell 2000, and the green line is the S&P Small Cap 600. And so you can sort of see that they track pretty closely, but when there are significant movements up or down, you see a little bit greater volatility in the green line, the S&P Small Cap 600 index, as opposed to the Russell 2000 in blue. But overall, in 5 years, you get a pretty significant outperformance from the small cap 600 versus the Russell 2000 index. And this is measuring that index with the IGR eShares ETF, which tracks the small cap 600, and it's got a tiny fee. So it's really expense ratio. It's really a tiny. So it's very close to the actual underlying index. Let me talk a little bit about the Russell 2000 so that you understand it. The Russell 2000 is determined by Russell as first determining the 3,000 largest companies by market cap in the US market. That's the Russell 3000 index. The largest 1,000 of those are the Russell 1000, which is their version of a large cap stock index. And the smallest 2,000 of the largest 3,000 companies become the Russell 2000. So we're not really looking at the 2,000 smallest companies of the market. In the market, we're looking at the smallest 2,000 of the largest 3,000 companies in the stock market. And so the result of this approach is that the average market cap for a company in the index is around $2.4 billion, and the median market cap is $744 million. 2.4 is outside our definition of a small company stock, but it also allows for the inclusion of companies that are as big as $9.8 billion by market cap. So the Russell 2000 has a company in it that has a market cap of 9.8 billion, which is well outside what we would determine to be a small company. And it's also an unmanaged index in that there's no other criteria that determines whether a company is included in the Russell 2000 as to the fundamental performance or earnings or anything else. It's just purely by market cap. It's rebalanced once a year, or as companies fall off, they can be replaced. And interestingly, there are often more than 2,000 companies in the Russell 2000. Again, the oddities of indexes and how they are approached. On the other hand, the S&P Small Cap 600 is determined by an editorial team that looks at companies and weeds out unprofitable businesses. And so it will take into account the companies that represent the small cap market segment and that are also profitable. If you look at the Russell 2000, 750 companies in the Russell 2000 have earnings below zero. So again, doesn't fit our approach to investing, but yet they're considered significant enough to be included in the Russell 2000 index. About 30 or 40 of the current Russell 2000 stocks are trading below $2 a share, which is, penny stock territory for us. That's just well below the price range that we would consider, because those companies just don't stand up to our scrutiny, our fundamental scrutiny. On the other hand, if you look at the S&P Small Cap 600, the median market cap was $1.2 billion. The range of market cap was 2.4 to 4.2 billion. So half the size of the largest company in the Russell 2000. So at the end of the day, I am contemplating making a shift in my consideration of what small cap index to follow in terms of tracking performance in our Small Cap Informer newsletter and here in our lunchtime webinars, where we discuss market segment performance to look at the S&P Small Cap 600. I think when the markets, when small company stocks go up, they both go up. When small company stocks go down, they both go down. But perhaps that small cap 600 is a better representation of the market. I know this may be philosophical to many of you, but for those of us who are living and breathing in the stock market and who are looking at ways of interpreting the market, it becomes something a lot more interesting and subject to a considerable amount of contemplation. There have been a number of articles on websites like MSNBC or CNN over the last couple of years, where periodically somebody pokes his head up and says, I'm thinking about this Russell 2000 small cap index, and it's not really a very good small cap index. And certainly evidence would point to an indexing strategy that wanted to incorporate small company stocks to not including the Russell 2000, but using a small cap S&P Small Cap 600 ETF or index fund instead. Because there is a pretty significant outperformance, again, when you're looking here in a 5-year period, 35.6% compared to 43%, the compounding effects of that over a much longer period would be fairly considerable. So that's something else that you might consider as you're looking at it. At any rate, small company stocks continue to be of interest to me, and I believe that for many of you, small company stocks are an area where you could be increasing the returns overall of your portfolio by looking at small company stocks. And so I continue to focus on those in many of my educational presentations and webinars. And so today we're going to take a look at a small company stock of interest. And I think the case study here, again, it follows a formula that we have utilized in our small cap newsletter that's worked pretty well. A little bit contrarian, but taking advantage of the shifts of sentiment that can happen very quickly for companies, and in many cases, those shifts are exaggerated relative to the news that's prompting investor behavior. And so think that this is another case where here's an opportunity for long-term investors to look beyond the short-term noise that's being generated by the market and perhaps increase the growth and return potential of your portfolio. And so the company that we started following in our small cap newsletter in June, so at the very end of May, was Canada Goose. The ticker is GOOS. It's a Toronto-based company founded in 1957, but they've been public since only for the last couple of years, since 2016. And it's grown to an $830 million Canadian company in 2018, and that's revenues have just about quadrupled from 2014. But in May, and so the company had been growing at a growth rate of 40–50%. Earnings have been growing at a 40% rate since 2014, annualized, and so it's just a lot of growth there. In May, they reported their fourth quarter earnings and included guidance for the coming year, and the stock price 30+% at the time, and continued to drop down a little bit more. And the reason for the bad news perception that as it was received by many investors was that the guidance that Canada Goose management provided was that investors should be expecting more like 20% annual revenue growth and 25% annual earnings growth over the next 3 years. So Canada Goose management doing the right thing, saying, hey, our expectation, our target here is growth of 20% for revenues and 25% for earnings over the next 3 years. And that is enough to put the stock into a tailspin. And so when you look at earnings growth in 2018, earnings were up 48%, so 25% is significantly lower. But from our perspective, a company that is able to grow earnings and revenues at a 20% plus clip over the next 3 to 5 years, if we can buy it at a reasonable price, that's perfectly adequate growth, and there's no reason to expect that growth would come in much below that 20 to 25% range. The company, if you're the management of a company and you're going to make this announcement because you're looking at the numbers and going, our growth is really slowing as we get a little bit bigger. It's harder and harder to earn 40% a year, to grow 40%. So they could have guided even lower if they thought that was warranted. So I take their warnings as being pretty conservative. They're trying to manage expectations, which is good. Again, from our perspective, management is giving us guidance about growth over the next 3 years. So that's giving us a very clear case of what we can reasonably expect and how much will we pay for it. So at that after the company's news came down, the PE ratio, which had been in the 50s, is now in the mid-20s. And in any market, when you can buy a company that's growing earnings at 25% a year for a PE in the mid-20s, that can be a great opportunity. So here is the price over the year to date, and you can see at the end of May where Canada Goose management has obviously, you can see where the announcement was, and the price went from the high 40s to below 35. They drifted down to the mid 30s, down to 30, 33, and you can see in just about 5 weeks now the stock is back up to 40. So from a low here of around $33, the stock has seen pretty significant gains. And again, this is the market absorbing the news and reacting. And yeah, the people who were expecting the stock to continue to climb from 50 and for earnings to to grow at a 40–50% rate are going to be disappointed. But people who bought when the stock price was 33, 35 are already seeing a positive return on their figures. Now, it's not to say that when companies come out with reduced guidance or warnings that the market is going to react the same way. But in my view, this was a company that was on my radar screen. It was a company that I've been watching. It's a company that I've been seeing their clothing labels when I travel and are around the country. The Canada Goose label is very popular. It's considered luxury clothing, but it is very functional, coming from this Canadian perspective about making clothing that actually performs. So down jackets are their mainstay, and they are functional and can be worn by mountain climbers and not just people on the high fashion types on Fifth Avenue or in Tokyo. If we look at their growth, since 2014, we've got data. So you've got this steady uptick in revenue growth, earnings a little less consistent, but the last from 2016, 2017, 2018, that growth has been pretty terrific. Has been trending up. So using the company's guidance for our projected growth, as represented by those red dotted lines, you can see, there's plenty of opportunity going forward. If you look at their profit margins, again, they've been expanding nicely. This is, terrific levels in the low 20s. So out of every dollar of sales, they're making about 22% in profit. And these are all Canadian dollars when we're looking at figures, and the prices are American prices, US prices. And that's just the way that we look at these Canadian companies. On the PE ratio history, you can see that PE ratio on the high side in the last few years. It's been drifting down, but only down to 44 in 2017, back up to a high of 56 in 2018. The low PE ratios have been down in the 18 to 25 level. Again, this is all based on fiscal year earnings. That current PE ratio right now is 31. Because at a stock price today of $40, just above $40. So it is, for a lot of people, when the P ratio climbs above 30, they get a little wary about about buying the stock. It is a little expensive, but at 31, I think it's still in that general area that, again, you're not going to load up and buy 40% of your entire portfolio into this company, but it might be a way to capture some additional growth and monitor it closely as you look at it. We look at the evaluating the risk and reward. So if we expect the high PE to be at that 30 level in 5 years, and earnings at about $3.19, the high price would be about $95. So that's more than a doubling from the current price of 40. On the low side, if the PE drops back down to 18, that gives us a low price of 23. And so even right now, after it's come back up from just below $32, it's still a 3-to-1 upside downside ratio. So I still think there's some opportunity here as the company matures to capture some faster growth in your portfolio. Again, monitor closely and watch out for it. When we talk about the Canada Goose, they do have e-commerce websites around the world. They have 11 stores that they've been operating, and these are in Soho in New York City, on Regent Street in London, in Tokyo, so in high high traffic, high rent fashion districts. They operate direct stores. Direct to consumer sales are now about 52% of revenue in 2018, and that's expected to increase quite a bit. This is a fairly new brand, so I think there's some life left into it. One concern when you're investing in apparel companies is that trends come and go, luxury goods as well. The luster fades, and we've seen that happen with brands like Coach or Michael Kors that get hot and then fizzle out. I think Canada Goose is still small enough that there's plenty of growth opportunity for the company from this point forward. The brand still will have value a few years down the road. They do have some increasing debt as they are opening their own stores, which are more profitable but are more expensive to operate. So the availability of capital is really important to that prospect, to be able to have a retail location that's attractive and in the right geography really makes a difference. And so at this point, I think I'm not concerned about the balance sheet issue, but want to make sure that they're not expanding that unnecessarily. So that's our Canada Goose. We can pull it up in Toolkit and just to see that compound annual rate of return from this price is 18.6%. And again, that's based on 20% earnings and sales growth. So you'll notice that I ratcheted that down from 25% from the management's guidance for earnings growth over the average earnings growth over the next 5 years. I think that earnings growth is going to probably be in the 30% range for 2019, and so and then we'll start to see that tapering off a little bit, and it's quite possible, as I mentioned earlier, that management has been a little conservative in their reduction of expected growth, and so potential for some upside surprises might occur from this point going forward. I mentioned earlier this is the formula that we used most recently with our Ollie's stock that we started covering in November 2000, the December 2018 issue of the Small Cap Informer. So this was published right before Thanksgiving, and let me pop off that index. So you can see we'll look at the 6-month prices. I guess we'll look at the 1 year, because it's been a year. So you can see the fall off here as we were coming into right before Thanksgiving. The stock got down to about 83, popped back up to 88, and then by Christmas Eve, it was back down in the low 60s. Since then, it's popped back up. It was as high as 100. It's back down to about 84 at this point. So a lot of volatility in the stock. The price has been climbing and going. If you bought it on Christmas Eve in the low 60s, you had a nice gain at over $100 in mid-May. It's drifted back down a little bit, but again, I think the long-term potential is pretty good for Ollie's over the long term when you can buy it at a reasonable price. So even if you bought it in the mid 60s to $84 where it's at today, that's still a pretty good price. All right, so some questions there. Steve asks, who are the peers of Canada Goose? Again, when we look at apparel companies, there are a lot of them. They tend to have different consumers that they target. So we can compare them to apparel manufacturing businesses, or we can look at luxury goods as a proxy for it. In the apparel manufacturing business, that's broad, so that includes companies that are more mainstream, and so that's we can you know what? I'll run over to our equity research service website, and we'll take a look at that and see how that see who they throw out as peers. So we'll enter Canada Goose, and they're gonna these competitors are just gonna be uh, yeah, small apparel manufacturers. So they're not going to be in that same luxury space that Canada Goose is. But you can see how they compare in terms of the industry group average for apparel manufacturers is 10.5%. So Canada Goose's average over the last 5 years is 14%. You can see that it's growing. It's over 20% now compared to Vince Holdings, Jerash Holdings, and iFabric, another Canadian company. These are peers selected as the closest companies by size to your selected company there. So you can see a lot of the return on equity comparison, debt to capital, you know, a lot of favorable comparisons for those particular businesses. But again, hard to find a direct comparison because of that luxury comparison of it. This is our equity research service peers, which are uses a similar but may not be exactly the same methodology as used on the SSG Plus. So let's take a look at uh, Jay says I purchased SILC. Make sure I've got it here. Let's take a look. Silicom, which is a company we've been tracking. Let me refresh the data, make sure we got the current prices. There's the last quarter. Earnings a little weak there. I haven't looked at this company yet. We track it in the newsletter. And so it's currently at $32. It's near the 52-week low. As a communications equipment, semi-stock, this tends to run on its own cycles, so you don't see the consistency that you see in a lot of other companies. So at this point, I don't have an opinion on it other than because I haven't digested the recent news. So my take on it is that it appears to still be a solid hold, and I'm not concerned about the volatility so much. The question of when to buy and when to sell is very individualized to every person. So we hesitate to say, oh, it's time to sell. We'll sell on suggest selling for fundamental reasons. We'll also suggest selling for vast overvaluation reasons. But simply because you bought it at a certain price at a certain date, everyone will have different objectives and different criteria for selling, whether you're holding in a taxable or non-taxable portfolio. So we tend not to get too involved in individual portfolio management decisions. Adolfo says, are the S&P small cap 600 and the Russell 2000 considered mutual funds, ETFs, or what, or are they only indexes? So that's a good question. They are both considered indexes, the Russell 2000 and the S&P Small Cap 600 are both indexes. So they are managed and published, but they also are available as index funds and as ETFs. There are a number of ETFs that track the Russell 2000 and the S&P Small Cap 600. The most popular ETF that tracks the small cap 600 is ticker is IJR, and that's an eShares ETF. And again, the expense ratio, as I mentioned, is very small. That's the most popular. For the Russell 2000, there are a lot more. It's a lot more popular. And again, when you go to various websites like S&P or like Yahoo Finance or CNBC or MarketWatch, at the top, they're often, if we go home here, if we go to Yahoo Finance home, at the top, you can see the indexes that they're tracking, the S&P 500, the Dow 30, the NASDAQ, the Russell 2000. right? And so that's their way of looking at the small company stocks. Tech stocks is represented by the NASDAQ, and small company stocks, and they point to the Russell 2000. So again, there's a practice there that has been utilized by these various media outlets, and my premise is that that's probably not enough, and maybe it's just for our particular approach as better investing, toolkit style investors. Maybe the S&P small cap 600 better represents small company stocks as we can consider them, because we're not looking at stocks that don't make money. We're not looking at stocks that for the small segment of our portfolio that have market caps of $9 to $10 billion, et cetera. So that's my approach there. Greg says he doesn't think the handout is right, so I apologize for that. I'll take a look at it and see if we can find the right one. Don says, does Better Investing give a list of high dividend yield stocks for growth and return? No, they have never focused on income and return. We do make a screening tool, My Stock Prospector, where you can screen equities for yield and payout ratio and identify and dividend growth, for instance, and create your own custom list. And that's something you can do. We're working on our equity research service website. We're actually, this is not available now. I'll give you a little preview. We're doing generating a REIT analysis module here. So this is just for real estate investment trusts. And so we have the industry averages only for the specific real estate investment trust industries, so diversified healthcare, hotel, motel, industrial, office, residential, retail. We are looking at funds from operations instead of earnings per share in these. And so, for instance, if we click on healthcare facilities, you'll get a list of all the healthcare REITs. We just recently started covering Physicians Realty Trust. If we look at the average profit margins or the average revenue growth of these, you can see Physicians Retail Trust is the second fastest by revenue growth. And so we have been started covering that REIT in our small cap newsletter. We also have, as part of our REIT study here, a REIT screener so that you can, and I think REITs are a great way if you're looking at particular dividends, so you can search for current dividend yield. But you can also say, let's find REITs with at least 12% growth of sales and funds from operations. Let's look at that are smaller. We won't look at the very large REITs. We'll look at, so we can look by revenue or by market cap. You know what, let's look at measure by revenues like we do. And so just very quickly, we can click find REITs and we can come up with a list of, in this case, 30 REITs that meet those primary comparisons. And so one of them is Extra Space Storage, which we've been covering for several years in our small cap informer, so that shows up on the list. Let's click through to see other REITs. And there's Physicians Realty Trust. It comes up on that list as well. So just a very quick screener. But the real interesting thing as we go through these REITs is that we enter a REIT ticker symbol, and you can look at the growth of the funds from operations and sales, but you can also see there's an SSG link, and this will download an SSG that you can load into Toolkit or into SSG Plus. No, I won't say that. It definitely will work with Toolkit, where we swap out earnings per share with funds from operations. And so that's going to be a real interesting game changer, make it a lot easier to study REITs in Toolkit, using the primary method. So we'll take a look at this in a little closer in our next session. We're almost ready to release it. We've got a few other fixes to put in place, but that is definitely something that if you're interested in dividends and yield and income, REITs can often be a great way to take a look at that. Our equity research service does have a 2-week trial that you can sign up for once if you'd like to try it. So, and yes, this REIT report, Terrence says he doesn't see this. It's not released to the public yet, so we're still in testing mode. But as I said, I expect it to be released in the next week or two, and you'll get an announcement about that, and you'll be able to check it out yourself and provide some commentary there. So Bonnie says the handout was correct. Maybe I uploaded it right before I started the webinar, so maybe you grab the old one, the one from our previous webinar. Anyway, I think that will be about it for today. Thanks for joining us at our webinar. I know it's a little quick, just trying to squeeze things in during the summer months when everyone's on vacation and things are slowing down. I hope you all had a good 4th of July holiday, and we'll look forward to seeing you at our next event. Just a reminder, the Better Investing and iClub Central will be in Philadelphia at the new Money Show there in September. We'll be in San Francisco at the Money Show there in August. And that Philadelphia event is new. It's the first time in Philadelphia. We've been going to San Francisco for about 10 years and always have a great show there. So if you're in the Silicon Valley, Northern California area, we suggest you look us up and drop in. We've been having, Money Show has been providing some additional events and meeting spaces for the Better Investing members in Seattle. We had a special reception with Steve Forbes. There were about 24 people who came to that reception, so that was a real intimate gathering that we were able to have in Seattle. So there are a lot of special things that are going on, so please check us out there. All right, we will see you at our next Lunchtime Stock Club webinar. So thanks again, and stay cool.